Forget oil. The world's most dangerous, volatile economic shortage is not sitting inside a pipeline or a fuel tank. It is actually hiding right inside your walls. As our aging electrical power grids begin to buckle and collapse under modern industrial demand, the global economy is running headfirst into a physical wall. We are facing a structural copper deficit 5 times larger than what all current operating mines on Earth can physically produce. This is not merely another routine commodity price hike or a temporary market spike. It is a global blackout waiting to happen. Copper has officially been weaponized on the international stage, and the desperate race to secure physical metal reserves is tearing global supply chains apart at the seams. With ore purity levels plummeting to historic lows across traditional mines and smart grid transformers failing under extreme baseline heat loads, this foundational industrial metal has become far more volatile than crude oil. If we do not unlock massive new sources of physical copper in the near future, the entire green energy revolution and the expansion of artificial intelligence will grind to a sudden, permanent halt. Imagine a world where the lights go out not because of a storm or a cyber attack, but simply because humanity ran out of a single red metal. To modernize our energy infrastructure, upgrade our regional power grids, and support millions of electric vehicles alongside massive computing facilities, global industry requires 500% more copper than we currently mine every year, yet the world's oldest, largest mining deposits are running completely dry. We are entering an unprecedented supply crisis that threatens to paralyze every smart city on Earth. Welcome back to Earnings Per Page, where we save you hundreds of hours of dense technical research by distilling complex financial trends, commodity dynamics, and business literature into actionable masterclasses. Today for video 52, we break down the ghost inside our electrical wires, analyze the catastrophic collapse of global ore grades, explore the emergence of the copper curtain, and map out the strategic realities facing investors as we approach a critical resource cliff. Recent smart grid failures and localized transformer brownouts across Europe and North America have exposed a terrifying truth that modern society has ignored for decades. The physical limits of our electrical transmission systems have been reached. For years, politicians, corporate executives, and regulatory agencies promised the public that software algorithms, digital smart meters, and artificial intelligence optimization could streamline existing power grids without requiring massive physical infrastructure overhauls. However, modern energy demand has exposed that promise as a dangerous optical illusion. Over 70% of North America's electric transmission lines and power transformers are currently operating past their intended 25-year design lifespans, with vast sections of the municipal grid dating back to the mid-20th century. These legacy systems were built to handle simple, predictable, one-way power flows from centralized coal or nuclear plants straight into homes and factories. They were never engineered to process multi-directional, highly variable power loads coming from distant solar farms, offshore wind turbines, and neighborhood electric vehicle charging networks. When utility companies attempt to force immense surges of high-voltage renewable power through legacy copper cables, the natural electrical resistance inside the metal creates catastrophic thermal heat. This localized overheating causes underground lines to degrade, transformer oil to boil, and suburban substations to short-circuit under baseline summer loads. There is an immediate, dangerous disconnect between ambitious net zero legislation passed in capital cities and the physical reality of empty warehouse stockpiles on the ground. Global warehouse inventories across the London Metal Exchange and COMEX sit at historically low operational buffers. When physical supply cushions evaporate, commodity markets become violently sensitive to minor supply disruptions. We are attempting to execute the largest technological and energy transition in human history, yet we are attempting to build it without the baseline physical metal required to construct the wires. To understand why refined copper prices are breaking decade-long records, we must look deep into the earth at the physics of mining extraction. Over 45% of the world's mined copper originates from South America, anchored by aging, multi-generational mines in Chile and Peru. However, these massive mining operations are suffering from a relentless geological phenomenon known as ore grade decline. 30 years ago, digging up 1 ton of raw Chilean rock yielded nearly 40 pounds of pure copper, a rich 2% ore concentration that made extraction highly profitable and energy efficient. Today, after decades of continuous extraction, that exact same ton of mined rock yields less than 8 pounds of usable metal, and ore purity grade dropping below 0.4%. This means mining conglomerates are forced to blast, haul, crush, and chemically process 5 times as much raw rock today just to output the exact same amount of copper they produced a decade ago. Processing 5 times the rock requires 5 times the diesel fuel, 4 times the industrial water, and double the electrical power, driving extraction costs through the roof while severely damaging local environments. Compounding this extraction crisis is the massive decade-long lead time required to bring a brand new greenfield mine from initial geological discovery into full commercial production. Developing a modern Tier 1 copper mine is one of the most complex, capital-intensive engineering projects on Earth. It requires billions of dollars in upfront capital expenditure, extensive environmental impact studies, securing scarce regional water rights, and navigating complex political negotiations with local communities. Over the last 10 years, global mining companies drastically reduced their capital expenditure on aggressive exploration, choosing instead to pay out stock dividends and buy back shares to satisfy short-term Wall Street investors. As a result, projects being discovered today will not yield a single commercial pound of refined copper until nearly 2040. The capital investment being deployed by mining giants today is years too late to stop the structural supply deficit that will lock the market in place over the next 36 to 60 months. Because copper is physical infrastructure, it is rapidly surpassing crude oil as the primary lever of international power, industrial dominance, and national security. Just as the 20th century was defined by control over oil pipelines and refining capacity, the 25th year of the 21st century is proving that modern technological power belongs to those who control refined copper supply chains. Today, China controls over 45% of global refined copper smelting capacity, processing raw ore from South America and Africa into ultra-high purity electrical wires and components. Recognizing this systemic vulnerability, major economic powers are moving away from open market commodity trading toward aggressive strategic hoarding. Western nations and Asian industrial centers are constructing an invisible copper curtain, signing exclusive long-term off-take agreements directly with mining companies to secure their future physical supplies. Smaller, developing nations are being completely priced out of raw metal markets, preventing them from modernizing their own domestic electrical grids or industrializing their local economies. Simultaneously, we are witnessing a dramatic surge in resource nationalism across key mining corridors in South America and Central Africa. Governments in host nations are realizing that foreign corporations have extracted their natural wealth for decades while leaving behind local environmental degradation. Consequently, host nations are raising mining royalties, tightening environmental regulations, restricting raw unrefined ore exports, and demanding that international conglomerates build expensive local smelting plants before exporting metal. This shift from free trade to resource diplomacy is creating violent supply friction, ensuring that sovereign access to copper will determine which nations thrive and which stall over the next decade. The global mandate to transition toward electric vehicles, electric heating, and high-density artificial intelligence computing presents an insurmountable physical paradox. A standard internal combustion engine passenger car contains roughly 30 to 50 pounds of copper wiring. In stark contrast, a modern battery electric vehicle requires nearly 200 pounds of high-purity copper to construct its heavy-gauge battery connectors, internal busbars, and high-power electric motor windings. Even more aggressive is the hidden metal demand of generative artificial intelligence hardware. Building a single 1 gigawatt AI supercomputing facility requires up to 50,000 metric tons of refined copper just for its internal power distribution networks, high-voltage step-down transformers, and liquid cooling cold plates. When hundreds of new AI factories are constructed simultaneously alongside expanding EV charging networks, the aggregate demand placed on electrical component manufacturers explodes exponentially. Here lies the core paradox. If millions of suburban households plug in electric vehicles while running electric heat pumps during peak hours, the total electrical load flowing through local residential substations will double overnight. Legacy copper cables buried under neighborhood streets will literally melt under the thermal stress. Digital smart meters, software algorithms, and smart grid applications cannot alter the physical laws of thermodynamics. You cannot code your way around a fundamental lack of conductive metal. This physical reality sets up a terrifying two-tier energy world. Wealthier metropolitan hubs and high-value tech corridors will bid copper prices up to astronomical levels to reinforce their electrical grids and keep their data centers running. Meanwhile, smaller municipalities, rural regions, and developing nations will suffer from persistent voltage drops, brownouts, and rolling blackouts because they simply cannot afford the physical copper required to repair their aging infrastructure. Can industrial engineering save the global economy by simply substituting copper with cheaper metals like aluminum? While aluminum is far more abundant and widely used for long-distance overhead transmission towers, its fundamental metallurgical properties make it physically impossible to substitute in microelectronics, compact EV motors, and high-density transformers. Aluminum possesses significantly lower electrical conductivity and expands dramatically under thermal heat, creating severe oxidation and high fire risks when packed into compact spaces. What about recycling? While scrap metal recycling provides a critical secondary source of liquidity, recycled copper currently accounts for less than 30% of total global supply. Scrap recycling processes face severe logistical bottlenecks, high sorting costs, and purity degradation, making it impossible for recycled scrap alone to fill a multi-million-ton structural deficit. Because substitution is physically limited and recycling cannot scale fast enough. Commodity strategists project a long-term structural price floor for copper that will force permanent inflation across industrial hardware, consumer electronics, and home electricity bills. To summarize our deep dive analysis into 3 actionable principles for your portfolio and financial planning strategy. First, recognize that physical constraints will always trump digital ambitions. Software companies, EV manufacturers, and AI hardware developers cannot generate revenue if physical power grids hit a physical wall. True long-term value belongs to the foundational physical providers, the copper miners, grid component builders, and high-voltage electrical engineers. Second, track the refined smelting and component manufacturing bottleneck rather than focusing solely on raw commodity prices. Pricing power and profit margins will concentrate in the hands of specialized companies that own the industrial technology needed to refine low-grade ore and assemble high-purity electrical busbars, transformers, and power delivery systems. Third, prepare your personal finances for structural utility inflation. Electricity prices across developed nations will remain elevated for the next decade as utility companies pass the multi-billion-dollar costs of grid retooling directly onto consumers. Factor higher energy overhead into your personal budget and investment return targets. Thank you for tuning into video 52.